comments also regarding the moment that we are now in terms of a capital market influencing reinsurers at this moment?
Sure. Thank you very much. Thank you everyone watching us. It's a pleasure being here. I think adding to the point of your question, Nagan, and to follow on what Wiggers was mentioning, I think when we get taking the story of the capital markets, comparing 2001 to today, we still see that, for example, when we got to 2001, 5 years before, the average US rate was above 5%. So we had a period of not excessive liquidity in the system because you had higher interest rates for a longer period of time. When we reached today, we saw 13 years of consecutive rates near zero, below zero in some instances, depending on the real interest rate and inflation on some of the central economies, but also a very, very low interest rates in Japan, Europe, and the US. So the point where we reached today is a point where the system had excess liquidity for a long time. The system was used for excess liquidity and cheaper access to capital. That drove the financial markets to reinsurance in the sense of using the collateralized structures, using the ILS, IOWs, and other instruments. However, when we see a very big peak of interest rates on the last year, this is, on one way, reducing the ability of these markets to regenerate capital because it's a business that they're not necessarily specialized in, and when the yields start to close against the risk-free rate, that's something that takes away capacity of raising new money. And what we're seeing also, to the point that Vickers was mentioning, is the number of new cat losses, and especially the new unmodeled perils, is generating higher discussion levels. Until last year, a significant tranche of losses from Harvey, Irma, and Maria losses were still being discussed. What that happened is that more than multiplied by 7, what we call trapped capital on the ILS industry. Trapped capital is the amount of capital that is collateralizing some of the reinsurance schemes, but couldn't be released or used because the amount of losses that they are there to pay is no longer available. For our traditional market, this is something we are highly used to discuss losses, to have reserves for a longer period of time. But what drove a lot of capital to that industry, especially the 144As instruments, which are traded on the secondary market, was the ability to get in and out quickly. And now we're seeing that trapped capital multiply by 7. This is reducing also the ability because that instrument was also used for a lot of markets to generate retro capacity and therefore deploy that capacity. So what we see is that same trend. Certainly the peak interest rates nowadays reshape it a bit, the investment portfolios and the capital structure of a lot of markets. Traditional big markets are seen constraining their ability to generate more capital and issue more premium because of that. Certainly the capital is there. We saw that the capital is abundant and it still is much higher than it was in 2001, that's for certain. However, at a much higher price just because the cost of capital is also much higher. And the amount of losses is not necessarily peaking in that sense, but we didn't have a Maria again in those last years. We didn't have a single event, as it was said before. However, the amount of cat losses happening have more than doubled when we compare to 2001 as well. The 5 years before and the 5 years of 2009, of 99 to 2004, the amount of losses now is 600 billion against 180 there. So it's more than double that amount. So that's also trapping and taking away capital from this industry.